What's up, everybody? Michael here. Cocoa Bear took the day off today and let the bulls run on these major index products. Today's video, we're going to be kind of diving into these expected moves and what we can expect potentially going to tomorrow, which we do have an extended holiday weekend. I will be creating a weekly recap too as well, but we got a lot to dig into on today's episode, so we're just going to go ahead and get right into that. We're going to focus now on the 11 sectors that make up the S&P 500. And I want to point out, you'll see some red highlights here. This is consumer discretionary, technology, and finance, okay? These are the three horsemen. When these sectors are up there and they're leading the way in the green, it is typical to see very, very bullish days in the market, and we got a very, very bullish day today. So consumer discretionary was 4.9, tech was 2.4, and then financials was 2.31. So let's take a deeper look into this, and why is it that I say that, hey, when these are up, the markets typically run too? Well, if you just look at the weighting of the SPY, you can see here, just in the top four, you have consumer discretionary, financials, and then information technology, which is technology and tech. By itself alone, we know is a huge weighting. That's about almost 30%. Then you add in financials, another 11 to 12, and then you also have consumer discretionary, so 30, 40, 50, almost 50% here as far as the total weighting of the S&P 500. So it's big moves. Now let's hop into some of these sectors individually. Okay, consumer discretionary, right? It is in a primary down trend, and we're seeing a relief bounce. So that's why I'm saying it is a bear market rally until proven innocent. But all we're seeing here is two very, very bullish type days. And we saw a little bit of increasing volume on consumer discretionary. You can see things like Tesla was up significantly on the day. We had the bullish crossover going. So we have some good developments taking place, which is telling me like, hey, as long as we can stay above this low, then maybe we can start building out some sort of bottom. Now, if you pay very close attention, you'll see this line here, and that line is the weekly expected move. So we're not like way outside of it by any means. We are right there. We tagged it, which tells me the upside going into tomorrow is somewhat limited. Okay, if we look at the BP chart, you can see here, I like to use this for overextended to the upside or downside. We had this positive divergence form. You can see a low to a very low low, who's a 5 reading, which is very overextended to the downside there, basically stating that a very, very small amount, right, 5%, is on buy signals that make up the consumer discretionary sector here. So we're seeing a big bounce from that bottom, and we're not quite overextended, which tells me there's still potential room to get back up into this area where we can say, hey, we're overextended there. But we are, like I said, on the top of the weekly risk range. Now, financials also, take a look. Okay, big move up. Where are we? Right on the weekly expected move. It's like magic. Holy moly. So tell me this, like, would you go long right here at this particular point in time? Me personally, no. I'm starting to look for short positions. Now, financials, it's also in a primary downtrend. On this one, though, the RSI is getting back above 50. You have a little bit more of a bullish crossover taking place, but pay attention to the volume. Look at that big move up today, up 2.31%, and that volume, it's on decelerating volume. That is a weak move there. Even more interesting is if you look at the BP chart, you can see here the RSI is getting to the overextended territory. So that is telling me that, hey, financials, this couple of day move, it's getting a little burned out right now. So we'll see here if it's going to take a little bit of a back seat tomorrow and potentially into next week, where it either consolidates, pulls back, or ignores all of these oversold conditions and we continue to rip. I mean, it's always a possibility. Take a look at technology. Technology is actually not there at the upper risk range, which tells me there's a possibility we can tag it going into tomorrow. So we will see. We can potentially even get outside of it and pull back a little bit. That's always a possibility. But also take note of the trend. Lower highs, lower lows, the trend still remains down. So one simple day, two simple day, three simple days up, right, especially on decelerating volume, isn't really too convincing at this particular point in time in this monster sector. If you take a look at the BP chart for this, you saw the positive divergence, right? It got very extended to the downside, right? A reading of 10, and now we're starting to rip up higher. Still shows that there's more room for the RSI to get into that overextended territory. So that is there a possibility. Now let's get a little bit deeper into this. This move to the upper risk range. If you take a look here at the dollar's risk range, take a look how interesting this is. The dollar is coming off, okay? And it's sitting at the lower risk range. And when the dollar comes off, a lot of these other products, well, they are moving to the upper end of their risk ranges. Go figure. Well, why is that? Well, there can be a bunch of narratives, but all I want to point out is, well, when the dollar has this rapid rate of change to the upside, we have been seeing weakness come in to the S&P 500 and various other commodities and so forth, right? So, but mostly I'm pointing out S&P 500 down here and the dollar up here. Now, dollar's been coming off, and then the market's been rallying. So a big question here is, hey, is the dollar going to find its footing? Well, overall, it is still in a primary uptrend, right? We broke out of this flag right here. So even a pullback to 99, I don't know if it'll get down there or not, but you got to understand it would still be in an uptrend at that point. So if it comes down here and we give some more relief where the S&P 500 could come up potentially up to 4,200, maybe even higher, that tells me that if the dollar starts ripping from that point, that can press down to just make, once again, another lower high in the S&P 500. So we have some interesting stuff taking place, okay? Mind you, all of this taking place on oil that continues to rise. Today it was up 3.4%. We're coming out of that tight 3-day pattern, which we discussed yesterday, and it's coming to the upper range here, or upper resistance, I should say. That was previously support and resistance. So we'll see if it starts to break out or if it's going to continue to just tighten up here in this area in bullish context. Now, why is this important to watch? Well, if you understand that oil has a big effect on retailers and also just the economy, right? These rapid moves to the upside are no good for consumers, right? So when you see consumer discretionary start to rise and consumer products start to rise, it is a little interesting to say the least. So when I pull up this, I want to show you what it is that I mean so you can visually see it. So this is the RLX. So this is retail, okay? A spider for the retails. And it's relative strength line to the S&P 500. And what I want to show you here is when the oil is trending up, especially moving at a rapid rate, what do you see the relative strength of retailers doing? Well, it puts pressure on the consumer. So retailers take the brunt end, they get beaten down. So this goes up, this goes down. So if oil wants to start coming back down, hey, maybe we are finding some sort of bottom in retailers and potentially consumer discretionary and stuff like that. But as it stands right now, oil is still holding up, and that is putting pressure on the consumer. Now, let's take a look here even deeper. We're seeing a very big move, 2-day move on retailers, and I want to show you this chart. So this is using a 2-day, right, rate of change because we saw a big 2-day move, right? And people are saying, oh, it's the bottom. Oh my gosh. It's just a bear market rally until proven innocent, okay? Take a look here. So we don't really get these massive 2-day rallies all too frequently. So 2-day rate of change, it's up 7.1%. So we saw that right here was most recent in February of 2022. We saw that big pop, and then it actually followed through with a drop. But I want to kind of preface this with these type of moves here. Also, if they can continue to just stay elevated, if they pull back and they start hitting this multiple times over and over again, that can signify a lot of strength coming in, creating some sort of a bottom. So, for example, if I bring up 2020, right, this was the pandemic crash, right? We can see it tagged here, here, and here on the rate of change. That was around the bottom, but take note, we saw a big pop, we saw it pull back, we saw it move up, we saw it pull back. So it gave opportunities. It built in higher lows as you'll typically see as bottoms form, okay? So it's not just like a 1-day event, it's a process, okay? Typically, there's always a low point, but it's a process to build a bottom, okay? Right here, this was, I believe, 2018. That was a big move to the downside, right? And the Fed, this was during the repo fiasco. You can see right here, bam, we saw this big move. Okay, it pulled back slightly. It started ripping higher. So this one was very aggressive at putting in a higher low. So that one got away quick and fast. And that was really, I think, around the Fed pivot area there. Okay, now if we go even further, I want to point out a couple of more. This was in 2015 we saw it, right? It saw a big move. And guess what? It started pulling back. And then you start to see these higher lows build. And then we started rallying from those areas, okay? Now, there is one time where most recently one time where it actually was a clearly a bear market rally, and you can see it started tagging it multiple times, and the more it tagged it kind of leading up to this, you saw this was the financial crisis. And very interestingly enough, right, we came up, we pulled back down, we rallied up, we pulled back down. Right here, we rallied, we consolidated, we ripped up further, and then we started to really sell off. And then when we started seeing these rip your face off even stronger rallies where it was up 15%, that was like, hey, should you be fading this? And boom, it sold off significantly harder, creating that bottom. And then boom, 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 it started forming, obviously multiple higher lows. So that is what we need to pay attention for, right? Rather than ticking, getting the right tick, you want to always ask where the price action came from. And as it stands right now, what I was pointing out is right now it's just moving straight up. So if you buy here and we're in a pullback, you're going to get scared on the move down, right? But then all of a sudden you might get out of the position. They might start ripping right back in your face, creating a higher low. So just be patient, right? This is just a game of patience as it stands right now. You don't necessarily want to just buy, at a super high rate of change, even though, it depends on your strategy, I should say, right? If you're a long-term investor and you're like, hey, I find this as an opportunity to add into my positions, okay, that's a whole different story, right? I'm talking a little bit more tactical right now. Okay, so let's continue on. Let's get a little bit into the S&P 500. The S&P 500 is outside of its weekly expected move. Yesterday's video, we talked kind of my bearish belief that, HYG was way outside of it, and there was one or two things that could happen. HYG can continue to rip and bring the SPY up with it, and that is what happened. Or the HYG can come in a little bit, and that can hold in the S&P 500 from getting outside of its risk range. Well, guess what? The HYG did take off, and S&P 500 did too as well. I'm short the S&P 500, I'm short HYG, and I'm short IWM. Today on these big moves, I used this time to manage some risk. So I took off some long positions, and then I added in some smaller size short positions to see here if we can come back within the risk range. So I'm just trying to play it tactically. If I get squeezed out of the position, I'm looking at about a 1.5% loss on both of those positions. All three of those positions, I should add. Okay, so we're coming outside of this. I entered into a short. I'll show you on the 15-minute time frame where that is. But keep in mind, 68% of the time it comes back within the risk range. Can we come back in there tomorrow? Well, we will find out. Let's zoom into the 15-minute time frame. We literally did not have an opportunity. So yesterday I kind of drew out a couple scenarios. Today, it just gapped up and ripped, and it didn't give any opportunities to pull back, not even do something like that, to break above the monthly VWAP, and it just got right outside of the expected move. Now, we did put in a subtle divergence here, right? We hit a high, a lower high, and it, is a negative divergence. So in my personal opinion, this is not a chase worthy at all. I would not chase this. I entered in short right around this point, I think it was. I'm pretty much flat on the trade, I believe. And I'm looking to see a pullback here into the VWAP, and then that's when I'm going to lower my stop in and see if it does break down further to maybe potentially retest that 5-day moving average that has been flattening out, which is positive. We just need to start seeing it turn up significantly more here. So overall, bullish development today, but just be mindful where price came from. It was a very strong move up, right? We've had strong move up before, but then they got faded really, really quickly. Okay, so not the greatest positioning for a long setup at this particular point in time, but maybe tomorrow we'll set that up for us. Now, if we dig another one, Qs tagged the upper risk range almost to the cent, which is very impressive. I think it was like 4 or 5 cents away, and we're talking a $300 product. So $300 product to be within a couple of cents, that is quite impressive, but just be mindful, right? 2.77% to the upside. We have RSI curling up over. I forgot to talk about the volume, right? The volume is on decelerating volume, moving up. That is a bearish divergence, and it's in a bearish trend. The SPY also decelerating volume on the move up there too as well. If we take a look at the 15-minute time frame, you can see we tagged it just about, right? It was a few cents, the upper risk range, and that is below the monthly VWAP there too, and the monthly VWAP did hold as resistance here. So we have a nice big confluence area of resistance telling me that, hey, not the greatest opportunity to push along here. But, you know, we can never rule out crazy things to happen. A lot of times where we have some resistance up overhead, the futures market gaps us up over it and then rips us higher. That has been seen multiple times. I don't necessarily know if that's going to be the case this time, being the risk ranges here and the monthly VWAP, but we got to be open to the idea. I'm not going to go long on a gap up by any means. I'm going to still wait for a pullback. Even if we don't gap up, I'm still waiting for a pullback and looking for better setups to start positioning long. Okay, if we take a look at the IWM, also tagged the upper risk range almost to the penny, came outside a little bit. That's when I initiated my short, and then now we are trading back within that risk range overall in a downtrend. We do have momentum building here on the MACD, right? But it's still below zero. Relative strength, right? It's not doing anything for us, and RSI is still below 50, but it is pointing up here. Okay, so it's good to see some strength. It's good to see a low and a higher low build, but just be aware the trend is your friend until obviously it changes, and the trend right now is down. If we take a look at the 15-minute time frame, it flew. Okay, so it got above the monthly VWAP yesterday, back tested, gapped up, and ripped right into that expected move, not giving us the opportunity to really buy into any pullbacks unless you're looking at smaller time frames in the 15, where it was just very, very quick little glitches to the downside. But that thing ran straight up to this. Very, 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 very strong type of move. Like I said, I'm waiting for some sort of a back test or pullback, maybe to the monthly VWAP. I entered in short slightly outside of this, so I'm in the money slightly, and I'm taking, you know, all my short positions, they're like half the size of my long position, so it's nothing crazy, and I'm risking like 1.5% on a small position. So it's just to have some exposure, potentially build into it, but really, I want the market to start turning around and forming a bottom, because I much prefer putting more weight into my long positions than anything. And obviously, it's been quite a difficult year for people that are long the market. Now, a couple indicators that I want to hop into. Pring bottom fish are starting to rip up higher, right? So it has marked a bottom, and we're starting to see some strength come from it. So good job on the Pring bottom fisher. The summation index, right? The parabolic SAR, it's now 3 days of being underneath it, confirming that we might be that change in the trend, and we're starting to see the market rip up higher there too. The 9 mot getting a little frothy here at 250, so I would imagine to see potentially this pull back a little bit. Maybe if this is still a bear market rally, we'll create some sort of negative divergence where the price action, you know, goes up higher maybe, and it's a negative divergence, something like that, and then we start to see it pull back down. But as it stands right now, big move, a big breath coming in there. And if you take a look at the NAMO, which is the Nasdaq McClellan Oscillator, it's just different, you know, calculation. It's not way overextended as we've seen prior, but you can see that it is, you know, getting a very high reading that we haven't seen really till this bear market rally right here, that everyone thought was, you know, the end all be all, right? The max, you know, everything was accounted for, and, you know, this was the bottom, and then all of a sudden we're not talking about that anymore because we cracked that low and started heading a lot lower a lot faster. Okay, now couple other more things that I want to add on, 2 more charts, so bear with me here. But the reason why I'm also saying, hey, I shorted, you know, IWM, and, you know, I'm not too confident that the market's gonna, you know, rip tomorrow like crazy. I think it's going to stay within these risk ranges like it has been doing, and that's really to do with volatility. Volatility on the Russell index, I mean, it is still above 30, so it's still high, and it's still within this contracting type pattern here. So be careful, right? I mean, this is in an area where, you know, really anything could potentially happen. So if volatility all of a sudden starts to uptick on us, we can see just massive swings, especially to the downside in the IWM. And then not only just Russell volatility, but if you take a look at the VXN, this is NASDAQ volatility. This is also, you know, above 30. It's, you know, above the 20-period moving average. Where do we land? So we close at 33.63. We're not even too far from 40, which can really get things messed up. So yeah, can it pull back down further? Obviously it can, but just be mindful that we're still elevated. Volatility still remains high, and we got to be careful for that. I don't have VIX volatility in front of me right now, but that was into the mid 20s. Okay, I'll actually just draw it out. It looked something like this, right? Boom, boom, boom. And then we had it go like this. And then we were looking at a box right here that was a gap, and it started coming in to fill that gap slightly right at around that 20, 2750 marker, I believe it was. So if this comes down even a little bit further on the VIX volatility index, you know, I'm pretty confident on holding my short positions at that point and maybe potentially trimming even some of my longs too as well, up until, I guess, we have some more data. That's all I got for you on today's episode, everybody. Hope it helped out, and I will see you back here on the next.